How much corporate debt is coming due in the next few years? And is that a risk to markets if companies are forced to refinance at higher rates? Joining us now is to explain to CNBC senior economics reporter Steve Leisman, the only person who's made it here on set with me.
I was going to have some fun with people today, but everybody's remote.
Sorry.
Anyway, Melissa, as you guys know and all the panelists here know, debt makes downturns worse, and Wall Street is keeping a close eye on corporate debt and the Fed with the 2008 financial crisis fresh in mind. One positive factor, so-called rollover risk, that's the amount of debt that comes due each year. It's a relatively tame but still meaningful $1 trillion, and that's investment grade and high yield that needs to be refinanced. That's about 10% of the $10 trillion corporate bond market. Bigger problems you can see are in 2024 and especially in 25 and in 26. John Giordano, head of credit research at Cantor Fitzgerald, tells me high yield and investment grade are in decent shape, but that doesn't mean there won't be pockets of pain. We'll be paying a lot of attention on how companies manage earnings and cash flow. Why is that? Well, it's because rollover risk is just one concern. Depending upon the depth of any potential downturn, earnings could come under pressure. Issuers then have to pay higher rates and a premium because of default concerns. There's already, you can see, it's the other side of Guy's chart there. Hefty default premiums and rates. Yields on the lowest rated junk bonds, they've nearly doubled from 8% to north of 15% this year. Investment grade more than doubled to just below 2%. To above 5% now on average. Daniel Iveson, he's chief investment officer at PIMCO, talked to him yesterday. He says when you enter recession, you never know if it's mild or not, and you got to be real cautious about most economically sensitive sectors of the market. So PIMCO, when it comes to credit, prefers these sectors that are less sensitive to cyclical downturns. Utilities, wireless towers, some tech, they call it mission critical software, aerospace, and food and restaurants. Some tech, and the optimistic scenario here. The Fed begins to cut rates before 2024 when the rollovers start. The current high level of rates suggests, though, the street is preparing for a worst-case outcome, Melissa.
How does a person like Iveson think about investing in corporate debt at this point? Because we've seen, the bond market overall has had a terrible year, no matter what corner of the bond market you're in, including investment-grade corporate debt. So there's a lot of corporate debt that's highly, highly rated from the companies we all know that are held by, companies that are not trading well. Maybe these are opportunities.
I think that's true. He said he doesn't love credit here, but he doesn't hate it either. That's part of his job is to look out the spectrum and look for different places where there could be value. And like I like to say, there is no risk except the risk you're not being compensated for. And so to the extent that you go out the spectrum and get to those junk bonds and get 15%, ask yourself the question, are you being compensated for that risk? And it may be true, considering, by the way, the risk-free rate has also come up, but spreads have widened too. That's what you want to do is watch the spreads. One quick thing, Melissa, there is a little ace in the hole here for your corporate bond investor. At these rates, there's not going to be a whole lot of issuance.
Right.
So supply will contract and otherwise remain the same at these levels. So that could help spreads a bit there.
Yeah. Guy?
Steve, that's a great scenario that you just pointed out. The fact that, maybe we see a Fed easing cycle when a lot of this stuff is due. Do you think, you've done this a long time, do you think these corporations understand that and will try to game it out by using sort of short-term debt to bridge till the point where they could start looking a little longer term?
So let me start off by saying any CFO who didn't term out his or her debt should lose their license to use Excel, in my opinion. That's pretty much what they were doing and what they did. And it looks like, Guy, they could have done this the right way. If you looked at that chart again and you looked at the bulk of this rolls over 24, 25, it looks like the CFOs were pretty smart. There is an area to watch, and I'll be reporting on this the next couple of weeks, which is the private credit market and the CLO debt that has very few covenants in it. That's another area where we're going to have to watch out for. Those have risen to be north of $1 trillion. But this looks like if they hit this right, this 2025 big peak right there, they might have hit it just right.
See, the thing, though, that troubles me is that it'll still be a while before rates actually come down. So let's say the Fed starts cutting in 2024. How quickly are they going to cut? And the rates comparatively to what the rates are right now, which is probably pretty much 0%, for a lot of that corporate debt, is still going to be relatively high. And what is the prompt, the catalyst that forces the Fed to cut rates? a recession, so earnings are weak. So we land in this
Melissa,
territory that doesn't seem like a great. I mean, yeah, it'll be better if the Fed starts cutting rate in 2024, but it certainly doesn't solve it.
I want to respond to that one part that you just mentioned there, which is a very interesting risk scenario that I think all investors need to be aware of. If inflation remains high and we hit a recession, don't look for the Fed to come and bail you out. Guy is 100% right. There is a Fed put when it comes to systemic risk.
Sure.
But there's not a Fed put when it comes to default and losses in the private sector. There's a difference there, and that may make the scenario somewhat worse. But you're absolutely right that ultimately most of these companies will be refinancing into higher rates as far as you can see, because I don't see zero on the. I mean, just imagine if on your $100,000 mortgage, your payment goes up from $8,000 to $16,000 on the junk bond level, and even for corporate now they're going to have to adjust. That means layoffs. That means cost contraction, other areas like that. They're going to have to watch themselves if they want to maintain their profit margins.